understand the modern banking system, we need to actually go back to the precursors of contemporary banking, which actually goes back to goldsmiths and bills of trade, which were in use by merchants in various parts of the world as a way to facilitate trade. So think about this. If I am a merchant and I'm going to different parts of the world and I'm carrying my spices and I'm getting money for having sold my goods, I probably don't want to be walking around carrying vast quantities of physical gold everywhere. It's heavy, it's inconvenient, and it's liable to get stolen. So what I would often do is I would go to a goldsmith and I would deposit my gold with that goldsmith. And the goldsmith would give me a little chit saying, your gold is with me, you can come and you can receive this gold if you give me this chit. Right? So I go to the goldsmith and I deposit 100 pounds of gold, and the goldsmith will say, here is a little chit that says that 100 pounds of gold is here with me. And very often the chit would basically say, pay the person who holds this chit 100 pounds of gold. They can bring this chit and I will give them 100 pounds of gold. Now it gets kind of interesting, and you pay the goldsmith a little fee for this service. You start to discover that whether it's against the goldsmith or whether it is against bills of trade, which are similar, where somebody gives you a bill that says, okay, I owe you so much, pay to the person, whoever brings this to me, they bring it here and I will give them that money. I have finished my trade, I've deposited my gold and I've got this little chit that says, the goldsmith will give whoever bears this 100 pounds. So I then decide, now that I've finished my trade here, I'd like to use some of my wealth to acquire new goods, to get new bales of silk, whatever it is. I could go to the goldsmith, I could withdraw 100 pounds of gold, I could then come to you, and then I could give you 100 pounds of gold, right? And what are you going to do? You're not going to just sit on it, you're probably going to take it back to the goldsmith. So what I do is I tell you this, what? You give me the 100 pounds of gold. Here, let me give you this chit that the goldsmith gave me. I'll just give it to you. You go collect the gold. So notice what happened. It's no longer the gold that's circulating. It's the goldsmith's chit that is now operating as the medium of exchange. And as long as everybody trusts that the gold is sitting there with the goldsmith, it turns out almost nobody actually goes to the goldsmith to receive the gold. I give you the chit and you're like, okay, yeah, I can do it, and then I've got this chit for 100, and when I then go to get my grain, I'll give it to the granary and I'll say, here, you go get the gold, right? The chits start to circulate. Now the goldsmith's in a very interesting position. He's got this gold sitting in the vault, nobody's coming to collect it. Not never, but at any given time, maybe 15-20% of it, the chits come in and people get to collect it, but the remaining 80% of it is just sitting there. So what's he going to do? He's like, well, I can lend it out, and when I lend it out, I'll earn an interest. And as long as I've got enough gold so that when people come and ask me for their gold and I can give it the 20% or whatever, my main source of income is actually going to be that I become what is called a financial intermediary. I become an intermediary who facilitates the process of borrowing and lending by actually coming in the middle, enabling people to feel secure by depositing their gold with me, and then lending that out to others. Now it gets even more interesting. When I lend it out, say, to the tailor, and I go to the tailor and the tailor says, well, I'd like to borrow gold from you in order to build a new machine, sort of shop. Sure, as long as you pay me back my interest, and as long as we've got a clear loan, and I do due diligence, and I make sure it's a proper investment, and you're not running off with the gold, and you're not just going to disappear and gamble in Vegas or something like that. Okay, this is a good investment. In this sense, investment means precisely the tailor is going to do the work of doing fixed capital investment by building the shop. I hope to get a piece of the future growth in income that will be generated by that action. promoting growth. And as long as the growth pans out, this is a very good thing for the economy. And my plan is I will get a piece of that future growth as my share, because I facilitated this process for you. But when the tailor comes, the tailor doesn't want the gold. What's the tailor going to do? Pick up the gold, carry it, right? Tailor's going to say, you know what? I want to borrow 800 from you, right? Why don't you just give me an IOU of 800? Because that's what I'm going to use anyway, right? So now it gets really interesting. That means that as long as the goldsmith is sure that no more than a fractional reserve of the IOUs that are circulating is called upon at a given time, the goldsmith's doing something pretty smart and good and useful for the economy. The problem is, supposing I tell my neighbor, you know, there's like all these IOUs floating around. The guy only has like so much in the vault. I'm going to get nervous, and then the rumor can spread. And so even if the goldsmith's right, even if the goldsmith will actually have the capacity to pay people off when the loan comes in, because it's a great loan and it's a wonderful tailoring establishment. If too many people come with these IOUs and say, give me the gold, this is called a run, in this case on the goldsmith, or a run on the bank. So part of what we are going to be interested in is the contemporary equivalent of this inside a banking system. In today's world, of course, what banks get is not a deposit of gold. What banks get is a checking account deposit by you. So to figure out how this works in a modern banking system, this is what we know. That the worth of a bank or of any unit is essentially assets minus liabilities, which means by definition, assets is equal to liabilities plus net worth. Right? And that's the way I'm going to do. And the net worth is basically a residual term, so that by definition, the two sides of the balance sheet must be equal. Right? So if you look at a bank, the key liabilities of a bank, what the bank has to give if somebody asks them to pay it up, is deposits. So when I make a checking account deposit into my bank, it means the bank owes me that checking account deposit, and it promises to give it back to me anytime I ask for it. That's what it means for me to write a check. When I write a check, I'm telling the bank, you owe me this money, please pay this person the money that you owe me. Right? What happens is the bank takes these deposits and it holds in reserve a fraction of these deposits. This is called fractional banking. In the United States right now, that fraction, it's usually set by the Federal Reserve. We'll talk about what happens with the reserve requirement in a bit. Banks hold in reserve in order to meet liabilities. If people come and withdraw cash from the ATM, or if people write checks, the bank has to have reserve to pay. The rest of it, the bank lends out. These are assets for the bank because this is loans that the bank has made, and the people will pay the bank the loan. But what's different is these loans are illiquid. So for example, when I borrow from the bank, so I borrowed from the bank for my home mortgage loan, right? The bank can't just come to me and say, oops, I made a mistake, I guess you'd better give me all the money back right now. I've got an agreement with the bank, and the bank has an agreement or arrangement with me about how I will pay off this mortgage over a 30-year period, and ta-da-ta, right? And as long as I meet my payments, that's what the bank has to accept. So what happens, and the bank makes money on the fact, or the bank earns an income on the fact that it is charging interest on these loans. And then as long as the deposits, it's loans, and then you've got your net worth, and the two sides balance to zero. Let's just focus for a minute on this relation. How does the bank actually create a loan? When I went to get a home mortgage loan, the bank didn't give me $350,000, $500,000, whatever you're paying for your house, in bundles of cash. What the bank does is it literally opens a checking account in your name. It's like that banker, it's like that goldsmith who just wrote out an IOU. So what happens is the bank literally, in the process of making loans, creates new deposits. In particular, what happens is when the bank makes me a loan for $300,000, I'm borrowing the money in order to spend it on some purchase I need, right? So I deposit the check, or I turn the check over to whoever I'm buying the house from. And that person deposits it in their bank, which immediately means their bank is going to get fresh deposits. And their bank then can keep a fraction of that in reserve and lend the rest out. And when they lend the rest out, the person who borrowed the money will use it, which will result in a new deposit, and so on and so forth. So what the end result of this is that the loan creation process generates new deposits in the banking system. And this will continue up to a limit that is set by the required reserve ratio. As long as I have reserves that are capable of backing my deposits, this process will continue. The reserves that a bank uses are set by the Federal Reserve, in that there is a maximum there's no maximum limit. A bank can decide that it wants to hold lots more reserves, but if it does, then it's not making loans. And if it's not making loans, then, it's not maximizing profit. Banks usually are careful. And then there are also things called sort of rules that govern the kind of loans the banks make. And we try and be careful with this, but, it's not always clear that the rules work. So we know that the housing crisis and the savings and loan crisis had a lot to do with the fact that banks made very bad loans. So of course, what happened is that they started collapsing because they didn't actually manage to get the loans to back the deposits. They were lending out money and so on. But usually there are rules, and these rules are often called Basel standards. This is from the city of Basel. And these are kind of agreed upon global standards that the global banking system is supposed to be following in order to make sure that the system is in good shape. Second, the banks are often backed by the Federal Deposit Insurance Corporation, or the Fed, FDIC. And that insurance means that the Fed is telling people, don't do a run on the bank, don't worry. Even if your bank goes down, I will guarantee you that you will not lose your deposits. So that prevents people from getting so nervous that they do a run on banks. The Fed also has rules about minimum reserves. So for reserves, banks are required to keep a minimum amount of reserves, and they are required to keep the reserves in very specific form. The biggest way in which banks keep reserves is either cash in vaults. This is for people who come and say, I want to withdraw $300 in cash, whatever. Or it is accounts that the banks themselves keep with the Federal Reserve.